Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter. There's a statement that somebody made, and somebody wanted my opinion on that statement. And I'll give you some data behind it. You guys can form your own opinions around it. And we'll jump in here and I'll give you my opinions around it. So again, if you need any help with anything, check out finding-value.com. And you can use the word discount in the coupon code. So let's dive in here. Let's see what's going on. So I'm going to zoom in here real quick. This guy says, same conditions in 1983 and 2023, absolutely. Same economy, same market structure, same market participants, same business cycle, same GDP, same macro, same global growth trade, same politics, is what this person says. It says, is this a possibility of the NASDAQ 2019, 2020, come all the way down? 2023 is what they put here, and a potential move higher. And this is what they've got: 1979, 1980, 1983. And what they're comparing are this fractal, basically, of 1920, 2023, 79, 80, 1983. Now, this very well could be a possibility, but there are glaringly differences between 1983 and 2023. And I'm not saying this can't go up here, but I think it's going to peak and turn back lower after that move. It'll be a much smaller move than these moves down here. The conditions are not the same. 2023 is nowhere near the same as 1983. But the fractal is the same. But you got to keep in mind, this fractal is a gigantic fractal. This one here is a smaller fractal. So let's dive in on what I think the market conditions are different. But just because these market conditions exist doesn't mean that this can't go up here and then turn at some point over here. Keep that in mind. So in 1983, if I were to yank up, let me yank something up here real quick. This is your commodity. So this is your commodity to stock ratio. And what we're looking at here is those time frames. Now, this is a big, long-term, big picture view. It doesn't mean that the short term can't go higher. That's not what I am stating. I'm just stating that in 1982, we were at a very high level for the stocks to commodity ratio. And commodities go up when this goes up, stocks go up when it goes down, this ratio. And we went down all the way till about 2000. We even peaked, came back up, and came all the way down. We are creating these valuations during certain market conditions. And you're going to get big downtrends or uptrends in valuations based off of the interest rates. So 1983 was actually a very cheap spot for stocks, and we were at the peak of interest rates. So those two things combined together basically give you a gigantic buying opportunity in stocks, because we just finished a rising interest rate environment. Here's the peak. Then we went lower for 40 years, all the way down to the capitulation bottom. This here is your tailwind. The move from here downward is your tailwind behind stock valuations. And that is what pushed stocks into an overvalued state. So if we were to look, we can go to longtermtrends.net, and we were to go to, let's say we go to the S&P 500 PE ratio, just to show you guys. 1980, the PE ratio was 7.6. And we went to ludicrous levels off the map of how expensive our S&P 500 ratio got. The way they got there, and the correlation that you need to think this through, is it's cheap because interest rates were so high. And we went into a very expensive region because interest rates got so cheap down here. So that is what the tailwind is expensive interest, or I should say high interest rates to low interest rates caused the valuations in the 1980, 1983 mark down here, 82, to go upward. And what that did is it pushed money flows into stocks. But now in 2023, we've got the exact opposite market condition. It's the exact opposite. We have stocks that are expensive on the upper side here, and we have commodities that are off the wall cheap. So yeah, we're down here for commodities, and stocks are expensive. That's the rotation. And we're expensive over here, especially in 2021. They were very expensive. We also have interest rates that are breaking a downtrend. It's a new shift to an increasing interest rate environment. The tailwind behind stocks is gone. So we could see this in terms of interest rates go up, but that doesn't mean in the short term that we couldn't see rates fall for a period of time before they go up, because we're shifting our time frames here. This is a 40-year time frame. I mean, if you look, this was the peak, and then this will say, oh, inflation is going to continue to go up, but it peaked again, and then we broke the downtrend line. So that is basically, we're in the two opposite market conditions. From the early 80s is completely different than the 2020s. 83, this is 85 that the breakout there. 85 and 2023 are the exact opposites. This one is signaling that we're breaking down from a long-term uptrend into a downtrend of interest rates. Here, we're breaking the downtrend into an uptrend of interest rates on the big picture scale. So stocks are probably going to come into headwinds and go sideways for a very long time. That's my opinion on it. So that's, and we've got high valuations. They're not down here at 7 or 5 or something like 6. Commodities are where these locations are at. Their PE ratios of oil companies are like 1 and 2 and 3. It's ridiculous. Up here, this is all overvalued land. I wouldn't want to touch those. Here's the Buffett indicator, market cap to GDP. In 1983, in that general vicinity, we were at 33%. So the Wilshire 5000 total market index was 33% of GDP. Now we're up in no man's land, and it looks like we peaked here. We're probably going to do another kind of surge higher, do either a double top or come a little bit lower and then roll back over, where valuations have to cool off. Something like, they did in 07 and bottomed in 09, back to a more normal ratio. But then they pumped it back up, pushed interest rates down, and that's what forced money back into the market, the stock market, that is. And you can use any of these long-term charts. This is stocks versus bonds. You can see that's off the charts where stocks are very expensive. This is all going to rotate differently when interest rates go up. We're going to have a very high ratio probably at some point, and then it's going to come back down, where the stock market crashes. That's my take on it. Stocks versus real estate. Stocks are expensive versus real estate. In 1980, stocks were cheap in relationship to real estate. In 1982, I talk a lot about these ratios, guys. In 1980, 81, 82, 83, that would have been the best time to buy stocks, like, period. Why is that? Well, it's because stocks were cheap against everything. Stocks were cheap against commodities. Stocks were cheap against real estate. Their valuations were cheap against, like, their price to earnings ratio, against GDP, against everything. Stocks were cheap in the early 80s. And we had a large demographic that came through home buying years, and it was on the tail end of that. I think what's going to happen is that we are going to get something on the lines that we are like in 1969 here, and we're going to go down in PE ratio and contract down to a bottom. And then after that, we could see a big move to the upside. Whenever you go to these expensive valuations, I think we're going to move lower in stocks. I think home prices are actually going to go either up or remain high. So that's stocks versus real estate. Dow to gold ratio. Look at the 1980s, guys. It was cheap against all this. Now we're up at a more expensive area. That is the difference. And the way that you make a lot of money is you want to identify where those valuation differences are in history. And then you want to buy the crap out of whatever the alignment is during your lifetime. You can't force stocks to be good during your lifetime if they're not good. I'll put it that way. So in 1980, you can see how cheap it was for the Dow to gold ratio. This is a perfect time to load up on stocks as much as you possibly can. Now I think it's the exact opposite. I think commodities are in that exact same period that stocks were in the early 1980s. So a better, I would say, a better comparison would be stocks in 1980 to commodities in 2023. They're like in the exact same location. Why is that? Because the stock valuations and how cheap they were in those valuations are the same as commodities are in their valuations today. So if I were to pull up a stock to commodity, so this is the CRB to S&P 500 here. And we went from 2008 all the way down to the bottom of 2020. We are at a very cheap valuation for commodities at this time. In fact, if you were to yank up, and I'll do it right here, it'd be a Dow to commodity ratio. And we were to look at this Dow to commodity ratio from a very long-term valuation level. This is what the commodity index to Dow Jones Industrial Average looks like over the 100-year time frame. So there it is over a 100-year time frame from 1917. You'd want to load up on stocks. See the 1980s here. You want to load up on stocks in the early 1980s. And every single chart, you want to see the full alignment. You want to see the alignment where stocks are cheap to absolutely everything. Commodities are cheap to absolutely everything during this time frame. This is the time that you can buy commodities like you could in the late 1960s, early 1970s. That is where you'd want to buy it, in this general location. You could see it had a big roundish bottom, and then we just blew to the upside. Why did this go to the upside? Well, it's based off demand and supply. So in the 1980s, we basically pushed through a demographic of home buying years. We were on the back end of it. And the reason we did very well for technology stocks and the S&P 500 during the 1980s and 90s is because you had a smaller demographic growth. It was called Gen X. They were slightly smaller, and the housing market was more in balance. It was in balance. It was balanced. It was in balance. And then we had interest rates fall that entire time frame. Now we've got the exact opposite market conditions with the exact opposite valuations. We've got, in my opinion, conditions that are coming up where commodities will be favored and they're extremely undervalued. This is like 1983 stocks is exactly what 2023 commodities are today. Exactly. So then the question would be, well, how much would you buy of stocks if you knew that? Well, you'd probably buy a whole bunch, right? What do you think I'm doing with commodities? I'm buying a whole bunch because on a big picture view, we've got market conditions that are changing where interest rates have broken their downtrend, that 40-year downtrend, and moving higher. We've got the valuations that are all in favor for all these different commodities. And then you've got the valuations in terms of price to earnings and all these other things, price to cash flow, all that stuff that are cheap in commodities. It's all expensive over in the S&P 500. So I think you're trying to run One of them, you're starting at the top of a mountain and you're going to run downhill. I know it's bad on your knees and all that stuff to run downhill, but your momentum can carry you down the hill. You can go down a mountain much faster than you can go up the mountain. In stocks, you're going totally against. You've got hurricane headwinds coming right at you, and you're going to be running up a mountain. That's not where you want to be, in my opinion. I'm not saying that all stocks can't go higher. I'm not saying that the short term that we're not going to go up. What I'm saying is big long-term, big picture view, that over the next decade or so, commodities are going to do something that we haven't seen in a very long time. And those who ride that commodity train are going to be rewarded very, very well. Commodities include, this is the physical commodities and the commodity equities and precious metals. They're all interconnected. This whole market is all interconnected with interest rates, and interest rates are interconnected with the demographic that's coming through. And we've got the millennials coming into home buying years, just like the baby boomers were in the home buying years of the 1970s. 1940s, we also had a large demographic come into buying years after the wars. They basically had kids in the 1940s. And then it just so happened 30 years later, it was in the 70s, which was the baby boomers, which just so happened about a good chunk later. We are now, they had kids in the 80s. You add some time, and now we're buying homes in the 2020s, in the millennials. So that's the cycle. That's the cycle. So is stocks like 1983? No, not even close. And this is the data that I'm using to suggest that they are not the same. Could stocks go up over the next 6 months to a year? Yes, they could. I'm not stating that they can't. What I'm telling you is the market conditions that he was describing are not the same. So they could go up. We could have an everything type rally for a period of time. Maybe they create currency. Maybe they do quantitative easing, pull those interest rates down where stocks are going to go back up. Something like that could happen. Or maybe it doesn't happen. Undeniably, though, commodities are cheap in relationship to stocks. And that's where I'm going to be. But so if that interests you guys, you can definitely check out findinghypervalue.com. You can check out the stocks that I own. I think I've got some of the most. I think I've got the good sectors identified. I think I've got the good. We'll call it leverage stocks to play this commodity bull market with. I think I'm in the right locations in terms of how big the companies are. I'm not in the big ones. I'm not in the super small ones. I'm kind of in that. I'll call it the perfect zone for very good risk reward. Good, they have cash flow. They've got good properties. They've got assets. They're priced below their PDP reserves. Some of these small caps are really mispriced, I think. And if the market conditions come where I think these commodity prices are going to go, they're not going to be anywhere near the prices that they are today. All right, guys, thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.